All right, Bulls and Bears. I hope everybody's doing good. We are back with another dose of economic reality. It is May 1st, so welcome to May. May 1st is May Day, May Day, May Day. Do we have any attacks or disasters happening on May Day? There was a few people out there predicting, some weird stuff going on for May 1st. As I'm recording this, nothing too crazy, except for the usual economic insanity, which continues. And I guess the big news today was the Fed holding rates steady. The announcement just made recently. I think everyone and their grandmother expected that. No one expected rates to be cut or raised. And they're in a squeeze right now, or the central bank's in a squeeze because they don't have any easy way out of the current situation. Now, one of the comments I see that's kind of annoying on this channel is, okay, here's the news today. You gave us the news. Thank you. Talking about what I'm saying or my reporting. And then they say, nothing's going to happen. Nothing's going to happen. Folks, if you don't think anything is already happening, then you need to open your eyes. The consumer, U.S. consumer, is under $17 trillion in debt. Something's not only happening, it's been happening, right? The accumulation of this debt is record breaking. And the question is now, how long and how much longer can the consumer last with this kind of debt, with interest rates that are not being cut? In fact, it's going to be higher for longer if you look at the inflation numbers, unless they do something completely insane and cut rates in an inflationary environment, which some people say they are either one, dumb enough to do it, or two, crazy enough to do that. Luckily, it didn't happen today. Rate cuts today in this environment would have been even a bigger wipeout for the U.S. consumer. Now, on one hand, you say, no, it's better because rates come down. But, folks, when rates come down, then prices rise even faster. So you may save a bit on interest. The interest rate's a little bit less for borrowing, but it means asset prices go up even more. So in the end, you lose even more, right? People think with low rates, okay, we're going to save money, it's better. It's actually worse in the end when you look at the cost of living and inflation. Now, if you get in at the very beginning, like if you would have bought, like let's say a home or did a major investment back in 2010, 11, 12, when rates were lowered after the financial crisis, that would have been the best time to get into stocks, real estate. Of course, if you get in right at the beginning. But now we're coming off of a 12-year reign of rock bottom interest rates. So to cut rates now would be absolutely bonkers, right? Well, let's get into some news here because I got a lot of things I want to touch on here today. I'm in a little bit of a celebration mode today. A stock that I've been holding since I bought it under $10 spiked. And I know some of you, a few of you, got into that trade with me. So we're maybe celebrating together unless you sold it all. But I still had some shares, and I recently sold off a little bit more. Another 30% spike in Carvana stock. Remember, people thought that stock was on its deathbed. And it was interesting, though, because at the same time that rumor was going around, they were building one of these Carvana vending machines in Mission Valley here in San Diego. So I knew that they're likely, weren't going to fade away like many retailers are fading away, especially with the what many people would say was the price gouging that was happening on the cars, on the car prices, right? We're going to talk about the car prices here in just a few minutes as well. But first, let's go ahead and get into this here. United Health CEO tells lawmakers that the company just paid a $22 million ransom. Wow. So some sort of attack or compromise of their computer systems made this $22 million payment happen, right? It was some sort of a compromise. That's a good way to say, or a good way to justify rate increases, right? If you're seeing your health care costs go up, so now they can say, we're not greedy. We have to raise our rates because we had to pay this $22 million ransom, right? So I don't know if I believe this, but that's what the headline is saying. To me, it sounds like a convenient excuse to keep prices elevated. I mean, please let me know what you think down in the comments. Oh, and by the way, got the glasses on again today. I've got something weird happening with my right eye. It's like it's got something in it, but I tried to wash it out, and it still feels like it's really red and irritated. So instead of looking just weird, I thought I'd wear my my economic supervision glasses here, but that's okay. But that gives me the supervision of the economy and where things are headed. All right, let's get into some other news here. Oh yeah, Carvana. By the way, I wanted to show you this chart for those of you that got in under $10. This is a beautiful thing, right? So let's bring this up here, and we see was that early to mid 2023 could have got the stock for under $10, and we zoomed up to $87 here today, and in fact, it got up to the high today was $90. It touched $90, and I sold just under $90, about just under $89. And so nice time to take profits. I'm still holding maybe 10% of my initial investment because I don't see too much more upside. This was a big earnings beat for Carvana, and you have to realize now what's going on. They're raising the price of the cars more than they actually have to, right? There was speculation that these car dealers, car lots were in trouble, but no, with the banks loaning out money the way they're loaning out, car dealers like Carvana and others were able to keep prices elevated. Now, some car dealers failed, especially the ones that had their own financing divisions and the ones that had the subprime loans as their specialty. We did see several of them fold back in 2023 because subprime is always the first to go. You probably remember even back in 2008, subprime was the first to fall, and then the rest of the market came down. Well, we are seeing delinquencies rise, led by subprime again, but unlike last time, the banks are not tightening the lending enough to restrict the economy, because basically the economy is people borrowing money and spending. It's not people spending money that they have saved. If people actually had to spend money they had saved instead of using credit or borrowed money, you would have witnessed an economic crash already. Why? Because the savings rate's near a 40-year low. In fact, in March, it just dropped down to a 3.2%, which is the lowest we've seen in many, many years. But anyways, yeah, back to Carvana. Those that got in on that trade with me, congratulations on that. Now, in our last report, we talked about several retailers and restaurants both that were talking about the big drop in demand. And we talked about it right here. We said, even last year, we said mid 2024, we're going to start seeing a big drop off in consumer demand. Consumers are under, like I said at the beginning, $17 trillion collectively in debt, interest rates staying elevated. Folks, the pain is not about to begin. It's beginning. Right now, it's beginning for the subprime people, the people that have the low credit scores, the people that have borrowed money just to survive up until now. Well, now it's going to start escalating up to the people that had money saved, and a lot of those people are eating through their savings, borrowing from their 401ks, taking out equity loans, cash advances, robbing Peter to pay Paul just to get by. So we know this is going to continue up the food chain, so to speak. All right, let's talk about the commercial real estate situation right now. We've got an office tower, and I see these every day now. Office towers, big commercial buildings being foreclosed. We've got the Loop office tower, and this is in Chicago, a $276 million foreclosure. So a couple things to ask here. One, who is the bank behind this? Who is financing this office tower? And two, what is going to be done with all these office towers, right? Some people say convert these office towers into apartments. That would be a big plus towards trying to solve what people are calling the housing shortage. Some people say turn these office towers into a homeless shelters. That would be interesting, very interesting. Can you imagine homeless people on the 70th floor? That would be pretty scary, actually. So I wouldn't recommend that for an office tower, but you might have people falling out the window. These homeless people are crazy. So you might have people falling out the window. It would look like an attack situation again, with that happening here. But yeah, commercial real estate continuing to implode. We're yet to see the fallout with the banks with all this commercial exposure. We saw a little fallout, I should say, with the banks that have failed. They did have commercial exposure. The one that just failed here recently, the ones last year. But this is something. The size of this commercial real estate implosion. We haven't seen just the tip. We've seen the tip of the iceberg, basically, is what I think. And they're going to have to do some massive bank rescues um, to help these banks stay alive. Otherwise, they're just going to get they're going to fail. They're going to get bought out. And the big news on that is, people originally people were pulling their money out of the bank because they were afraid that the FDIC couldn't cover them. And it's true that FDIC has about 1% of all the cash they need to rescue the depositors. But then we just saw the Fed and the Treasury come together and just create the money to rescue all the people for the failed banks so far, especially the ones in 2023. And what I've said here, the question that I've been asking here is, okay, if the Treasury and the Fed are just going to get together and quote unquote print the money or create it, why do we need the FDIC? I mean, what's the purpose? So to me, it's just an entity that's put out there to try to keep people confident that they're going to be covered, if the bank goes down. Let's talk about used car prices again here. And I should have talked about this right after Carvana, but the average used car payment is more than $700, folks. And we talked about here that a lot of people have this $1,000 plus car payment. It was 15% of borrowers, but the average now is 700, folks. This is over double just in the past few years. So again, we have to ask the question: how much longer can consumers keep swimming in these type of dangerous waters, shark infested waters, right? So you're going to see defaults continue to rise, rates staying elevated. So it's just a matter of time. And again, things are happening. You just have to know where to look. The debt continues to rise. Inflation continues to worsen. So rate cuts are off the table. So this is a formula for disaster, folks. I don't know how else to say it. Things are happening. You just have to watch all these numbers and data, and pretty soon it's going to be obvious to everybody. I think we're going to see something big, I think, drop this year, or crash or implode. Could be the banks, could be something else. There could be some sort of bigger event to take people's eyes off of the economic implosion, if you know what I mean. Let me look for another item I had pulled up here for you guys on the same topic. Missed car payments rise across the country. And this is out of the Make 'em Daily. Of course, they want me to subscribe, but it does give us some good data here. A new study revealed Michigan has the seventh highest percentage of auto loan balances with more than 90 days delinquency. Now, they're focusing on Michigan because this article is out of Michigan. But we see this nationwide. Between 2022 and 2023, the percentage of auto loan balances over 90 days delinquent in America increased from 3.8% to 4.2%, with some states coming in as high as 7%. Now, you may think that that's not very much, between 5 and 7% in some of these states. But remember, it only took a 9% delinquency rate during the financial crisis to help bring down the economy at that time. We're already halfway there, and things don't look to be improving. Actually, things are looking to get worse. They worsen every time we look at the numbers, right? The numbers aren't going down. The delinquency rates are going higher. We've got another round of layoffs, folks, out of Tesla. And we see the electric car prices continue to come down. The mania of people piling into electric cars because of the higher gas prices has subsided, combined with the state of the U.S. consumer. So many people in debt. People now, one, afraid, and two, to take out these big loans for electric cars. So we're going to see further price corrections in electric vehicles. And there could be a resurgence if gas prices and oil prices continue to stay elevated or move higher, which I think is very, very likely, especially with all the conflicts happening right now over in the Middle East. In fact, I would have expected oil to be $100+ right now, but maybe we'll see that going into summer as demand picks up, combined with the output reductions out of the OPEC nations. We could see prices start moving up big time, and then maybe that would rekindle some of the demand for these electric vehicles. But for now, a lot of layoffs being announced and a lot of pain being felt there over at Tesla. Now, one thing with the rate decision out of the central bank here recently was the announcement of QT tapering. What does that mean? That's quantitative tightening. Quantitative tightening is where instead of buying up assets and taking bad loans, for example, off of the books of the banks, they tighten, meaning they're selling off assets from the Fed balance sheet into the market. And when that happens, you see rates spike and rates yield spike and rates go up, including mortgage rates with mortgage-backed securities when they are purchased, by the central bank, the buyer and lender of last resort. Now they're going to be tapering this. So tapering the tightening, what does that mean? That means more loosening. That means suppression of rates. So even in this inflationary environment where they're afraid to cut interest rates, they're doing this tapering of the quantitative tightening. In fact, you can call it quantitative easing. That's what they're doing. They're easing from the position they were at. So instead of calling it a tapering of the tightening, which is kind of a confusing term to use, just say they're doing quantitative easing. That's what they're doing, right? They're making things more easy. They're making rates lower and suppress, making it easier for people to borrow more money. It's the only thing they can do is continue to try to keep kicking the can down the road until the inevitable end of this economic boom that people are calling it a boom. Really, it's not a boom though. If you've been on this channel, we've referred to this as many different things. A lot of it's just lending, spending, and pretending, right? So there's a three-word rhyme that I think sums up pretty good what's happening. It's lending, of course, banks loaning out money. In most cases, money they don't even have in deposits because of the deposit requirement was slashed several years ago in an emergency in 2020. Well, folks, that emergency is still here because they haven't taken away that zero reserve situation. And ask yourself why. If there's an economic recovery, why can't we take away the emergency programs that were implemented back in 2020, right? Very simple question, not a simple answer. So you've got lending, banks loaning out money, unleashed spending, of course, borrowed money gets spent, loans, etc., credit cards, etc. And then after the spending comes pretending the economy is good. Oh, look at the low unemployment number. Look at the jobs added. Isn't it great? In the meantime, it's people losing their job, going to work 2 part-time jobs, etc., making these numbers look really better than they are. And on top of that, the numbers are just phony to begin with. If you look at the government numbers, U.S. retailers confirm another 169 store closures in just 1 week. Among them, Urban Outfitters, Walmart, and a premium grocery chain, folks. 169 a week. I have to get my calculator out for that one. 169 times 52, and these aren't the entire franchises going under. This is just locations, but multiplied by 52, that's going to be close to 9,000 closures in 1 year if you annualize that, folks. So this is not normal. This is not a sign of economic strength. And again, to those that think nothing's happening, look at these numbers, right? These numbers are staggering numbers, and it means that things are only going to get worse going down the road here. New energy rules will raise the cost of a new home by $31,000, right? So we have these energy conservation requirements that are being implemented in cars also, but homes, newly built homes, and it's going to make the prices higher. And it's going to be another inflationary force. And you know my view on the housing market, there's inflationary versus deflationary forces. Higher rates, higher mortgage rates, the deflationary force, but you still have these inflationary forces fighting against it. Things like this, the cost of material, the overall cost of living. A lot of things are leading to home prices staying elevated, right? The banks able to loan out money that they don't have. Inflationary force, right? So what's going to win, the inflationary versus the deflationary forces? Well, we just have to sit and see and wait and see and try to be in the best position that you can here. Right. So on a personal topic here, I went out and got a new grill. And why am I talking about this on a financial channel? Well, the grills are pretty pricey. The 4-burner grill that I wanted was like $280. I happen to have a Home Depot offer to get 10% off. So if I use the card, so I did that to buy the grill. But the reason I'm talking about this is because I personally am boycotting fast food restaurants, right? We used to go out and get some fast food every now and then. Now completely not going to do that anymore. Not going to support these fast food chains, and see how this goes. We're going to just buy whatever from the store, cook it up on the grill. Had some nice grilled organic vegetables last week, and now the new grill, I'm doubling down on my position here, saving money by not dining out at these fast food restaurants. It's the only way I can think to fight back against these rising prices. Now, some people say it's not the fault of the fast food restaurants, right? They're just paying what they have to pay with this, especially here in California, the $20 an hour minimum wage now that fast food workers have to make. That's forcing a lot of the fast food places to raise their prices, right? So if more people stop buying this stuff, and this is the only way to solve it, right? You've got to stop paying these elevated prices. Like we talked about a few reports ago, we showed a video of a girl who paid $7 for this organic apple. It was a big apple, but she bought it at one of these health food stores, and it was organic and it was big. She paid $7 for an apple, folks. You got to say no at some point to these overpriced assets, overpriced restaurants, fast food. So I'm saying no by cooking at home more. And on the weekends, it's going to be JJ in the backyard cooking on the grill, no more fast food. I don't go to Starbucks. I mean, unless there's an emergency where I have to get a caffeine fix because I'm on a long drive or something and I'm tired, falling asleep at the wheel. An emergency, sometimes I'll do that. But for the most part, I'm cutting back big time on paying too much for a lot of things that we see right now. And that's the way we all need to fight back, folks. We all need to take a little extra time and be more choosy about what we choose to spend our money on, or be smarter. Be smarter about what we choose to spend our money on. All right, but we've been going over 20 minutes, folks. We're gonna wrap this one up here. Thanks everybody for watching. Please make sure you're still subscribed and come back to this channel for our next video. See you next time, everybody. Keep stacking now. Peace.